Welcome back, investors. In the ever-shifting world of finance, staying ahead of major economic trends is the key to successful investing. And right now, all eyes are on one powerful institution, the US Federal Reserve. If you've been tracking the financial news, you've likely heard the growing consensus. The Fed is poised to cut interest rates, with many analysts pointing to a move as early as this October. But what does that actually mean for your portfolio? It's not just a minor policy tweak, it's a fundamental signal that can trigger significant shifts across the entire market. A rate cut is the Fed's primary tool for stimulating a slowing economy. By lowering the cost of borrowing, they encourage businesses to expand, hire, and invest in new projects. For consumers, it means cheaper loans for cars and homes, boosting spending. This injection of cheaper capital acts like fuel for the economic engine, but it also dramatically changes the calculus for every investor. Suddenly, the low-risk returns from savings accounts and government bonds become far less attractive. This often pushes capital into the stock market in search of higher yields, a phenomenon known as a risk-on environment. This shift in capital flow is why understanding which sectors are best positioned to thrive is so critical. It's about anticipating where the smart money will flow next. That's exactly what we're here to do today. We're going to break down the top 5 stocks and sectors that historically perform well and are strategically positioned to benefit from a lower interest rate environment. We'll explore the mechanics behind why these areas are set to gain, from growth-heavy tech to debt-sensitive utilities and real estate. So, if you're looking to not just react to the headlines, but to proactively position your portfolio for the changes ahead, you're in the right place. Stick with us as we unpack these opportunities, because the insights in this video could provide you with a strategic roadmap for navigating the coming market shift and uncovering powerful investment ideas. Now, before we jump into the list, let's quickly talk about why rate cuts matter. When the Fed lowers interest rates, borrowing becomes cheaper. That means more spending, more investment, and more liquidity in the system. Typically, this can boost growth stocks, dividend stocks, real estate, and even certain financial companies. But not all sectors benefit equally. That's why I'm breaking down the 5 areas you should be watching in October 2025. First up, real estate investment trusts, or REITs. REITs are incredibly sensitive to interest rates. When rates fall, mortgage costs go down, property values tend to rise, and investors looking for yield often pile into dividend-paying REITs. Think about companies like Realty Income, O, or Prologis, PLD. These are income-generating assets, and as borrowing gets cheaper, they often see a big boost. If you're into monthly dividend stocks or high-yield income plays, REITs are worth putting on your watch list. Let's move on to our second sector, a true heavyweight of the economy, banks and financial institutions. When the Federal Reserve even whispers about changing interest rates, this is one of the first sectors that Wall Street turns its attention to, and for good reason. Their entire business model is built around the cost of money, making them incredibly sensitive to the Fed's every move. Now, at first glance, this might seem counterintuitive. It's a common misconception that lower interest rates are universally bad for banks. The logic goes that since a bank's primary income source is the spread between the interest it pays on deposits and the interest it earns on loans, a metric known as the net interest margin, or NIM, a lower rate environment would naturally squeeze this margin, hurting profitability. And while there's truth to that, it's only one side of a much larger, more dynamic equation. Here's the crucial flip side that savvy investors understand. The Federal Reserve doesn't cut rates in a vacuum. It does so to stimulate economic activity. Lower rates act like a green light for borrowing. Suddenly, that new car loan, that home mortgage, or that expansion loan for a small business becomes significantly more affordable. This reduction in the cost of borrowing unleashes a wave of demand across the economy. This is where the giants of the industry, like JPMorgan Chase, JPM, and Bank of America, BAC, can truly shine. Think about it. Mortgage applications surge as home buyers rush to lock in lower rates. Businesses, feeling more confident about the economic outlook and armed with cheaper capital, are more likely to invest. Consumers are more inclined to use their credit cards for big-ticket purchases. This surge in loan origination and transaction volume is the powerful counterforce to a shrinking net interest margin. Essentially, it's a classic case of volume over margin. A bank might be making a few less cents on every dollar it lends out, but if it's lending out significantly more dollars, the overall profit can actually increase. Furthermore, it's not just about lending. A healthier, growing economy spurred by lower rates benefits banks in other ways too. Their investment banking divisions get busier with more IPOs and M&A deals. Their wealth management arms see assets under management grow as stock markets rally. Because banks are so deeply intertwined with the health of the economy, their performance is often seen as a barometer for broader economic sentiment. When the economy is poised to grow, financial stocks are often at the forefront of the rally. So for investors, watching this sector during a rate-cutting cycle isn't just about tracking interest margins. It's about understanding the bigger picture, the surge in economic activity that lower rates are designed to create. Our third area of focus is a sector known for its explosive potential, technology and high-growth stocks. These are companies expected to grow much faster than the market, as they constantly reinvest in themselves to fuel future expansion. So why are these stocks so sensitive to Federal Reserve decisions? It comes down to the cost of money. Growth stocks in fields like artificial intelligence, semiconductors, and cloud computing are hungry for cash to fund research and expansion. When the Fed cuts interest rates, borrowing becomes cheaper. This cheap capital is the lifeblood that allows these innovative companies to scale up and capture market share without high financing costs. There's another key reason tied to valuation. A growth stock's price is heavily based on its projected earnings far into the future. Analysts use a discount rate tied to interest rates to determine what those future earnings are worth today. When rates fall, the discount rate falls too. This makes distant profits more valuable in the present, pushing stock prices higher as investors pay a premium for future growth. We see this with companies like Nvidia, whose growth is tied to the capital-intensive AI revolution. Lower rates make it easier for its customers to finance new tech infrastructure. The same applies to Microsoft's Azure cloud services. It's not just the giants, smaller software as a service or SaaS companies, which may not be profitable yet, rely on affordable capital to grow. For them, a rate cut is a lifeline. History provides a clear precedent. The tech-heavy Nasdaq index has a strong track record of outperforming during monetary easing. When the Fed begins a rate-cutting cycle, investors often rotate capital from lower-yielding bonds into assets with higher growth potential, which has historically ignited powerful rallies in the tech sector. As we look ahead to Q4 2025, the technology sector is a critical area to watch. While you can invest in individual stocks, tech-focused ETFs like QQQ offer broad diversification. Remember, higher growth potential comes with higher volatility. But for investors with a long-term horizon, this is where significant opportunities may lie when the Fed pivots. Fourth, utilities and infrastructure stocks. These are seen as safe, dividend-paying plays. When interest rates fall, their dividend yields become more attractive compared to bonds and treasuries. Think about companies like Duke Energy, Duke, or NextEra Energy, NEE. Lower rates can also encourage infrastructure spending and green energy projects, making this a defensive but also forward-looking sector. And rounding out the list, consumer discretionary. Lower borrowing costs mean consumers have more money to spend on things beyond the essentials. Retail giants like Amazon, AMZN, Home Depot, HD, and even travel and leisure companies often see a boost. This is especially important heading into the holiday shopping season of 2025. With interest rates dropping, expect retailers and discretionary spending names to get a nice tailwind. So there you have it. The top 5 sectors that could benefit from Fed rate cuts in October 2025. Real estate and REITs, banks and financials, technology and growth stocks, utilities and infrastructure, consumer discretionary and retail. Now, this doesn't mean you should rush out and buy all of these. Always do your own research, look at valuations, and consider your risk tolerance. But historically, these are the areas that shine when rates come down. If you found this video helpful, make sure to hit that like button so more investors can see it. And don't forget to subscribe to the Piggy Bank Chronicles for more videos on investing, stock market analysis, and wealth building strategies. Question of the day. Which sector do you think will benefit the most from the upcoming Fed rate cuts? Drop your answer in the comments. I'd love to hear your take.